This is Franchise Today, brought to you by FRM Solutions, providers of the best-in-class software solutions for franchise relationship management. Franchise Today is your destination for weekly information, conversations, and interviews with accomplished industry leaders, all of whom share best practices for sustainable growth and sensible franchising. Here now, your host, Stan Friedman, to kick off this week's podcast.
Today is Wednesday, July 24th, 2024. I'm Stan Friedman, and this is Franchise Today. Well, while finance isn't my primary area of expertise in franchising, these 2 last weeks have been fascinating for me nonetheless. I suppose anytime I get to participate in conversations around things that are on the leading edge, I find myself fully immersed and engaged. And that's what these past 2 interviews have felt like to me. Many thanks again to Sean Morrison at Diversified Royalty, David Earle at Stratus Building Solutions, and my good friend Ron Feldman for quarterbacking the connections between us, enabling me to present this information to you over the course of the past 2 weeks. This week, we remain in the capital arena as we will be joined shortly by Alicia Miller, strategic advisor to franchise founders, leaders, and investors. But first, a quick reminder to stop by the website at www.franchisetodaypodcast.com. There you'll find hundreds of interviews available for streaming or download dating back some 15 years with many icons of the franchise world. You'll find summaries of the interviews, show notes, blog posts, and of course, the opportunity to drop a review and let others in the franchise world know how much you enjoy listening to Franchise Today. It does me a world of good to hear from you, so your feedback is invited and appreciated. Okay, enough about that. A quick time out, and when I return, I'll be joined by private equity expert Alicia Miller, author of the best-selling book, Big Money in Franchising, Scaling Your Enterprise in the Era of Private Equity. Don't go away.
Franchise Today will be right back, but first, a word from our sponsors.
We are all familiar with Vistage, YPO, and EO. Well, now comes Zohr Forum, a somewhat similar type of executive group, but this one comes with a twist. Zohr Forum groups are exclusively for franchisors. Imagine a peer group for sharing and networking on a platform built exclusively for franchise executives. Zohr Forum members are afforded unparalleled access to best practices and some of the brightest minds within the franchising world through regular meetings and a dedicated communications platform. In this post-COVID world, a franchise-specific mastermind or peer group is an endeavor worth making time for. Zohr Forum groups of 6 to 10 will bring leaders together that are in similar situations, but with exclusivity in terms of their competitive set, so that each can openly help others benefit from their respective knowledge, perspective, and experience with no fear of competitive loss. Network, learn, strategize, and remain motivated along your journey. Join a peer group, not just any peer group. Join the only one designed for emerging franchisors. Join Zohr Forum. Learn more at zohrforum.com. That's www.zohrforum.com. Private equity is profoundly transforming the business of franchising as companies increasingly perceive PE transactions as an attractive alternative to going public, and as investors realize the strength and resilience of the franchise business model. In recent years, franchisors and multi-unit franchisees, encompassing more than 700 brands, have partnered with private capital, including Subway, which announced in 2023 that after decades of independence, it would be acquired by Rourke Capital for more than $9 billion. It's estimated that private equity is currently sitting on at least $1 trillion of dry powder, committed funds that have yet to be deployed. Franchising will continue to attract investment out of this substantial and still growing pool. As the founder and managing director of Emergent Growth Advisors, a boutique strategic advisory firm working at the intersection of franchising and private equity, CFE Alicia Miller supports founders and franchise management teams facing growth, disruption, or transformation challenges and helps them accelerate their businesses. Alicia also advises private capital firms pre- and post-transaction on strategy and value creation initiatives and co-invests alongside her partners. Alicia also currently serves as an independent director for Elevated Ventures Group, a private equity-backed multi-unit franchisee of Urban Air Adventure Parks. She's an advisor to the IFA's CFE program, a monthly columnist for Franchise Times, and Alicia has been published in Entrepreneur and Forbes for a total of more than 80 articles on franchising and private equity. She earned her MBA at Wharton, her Master's of Science from the University of Maryland, her BA from Smith College, and she holds a graduate certificate in franchise management from Georgetown, along with a graduate certificate in administration and management from Harvard University. And she's here today to talk with us about all of that and more. Alicia Miller, welcome to Franchise Today.
Thank you. Glad to be here.
Happy to have you here. It's not every day that I get to talk to somebody with your credentials, Alicia. There should be more of the formally educated in the franchise world than I think we sometimes find. But we'll unpack all of that and talk first and foremost about how it is that you found the franchise world and what were you doing when that happened?
Sure. So I worked mostly in go-to-market roles for about 20 years, all in high tech. Worked for a number of startups. A couple of them went public during the go-go 90s, and then a large consumer electronics company. I loved it. I loved that work. I traveled the world. It was exciting, and I saw a lot of places. It was great. But then I had my daughter, and I was 41 when I had her, so I was a little bit older. I didn't want to be on airplanes to China anymore. It just not the kind of mom I wanted to be. So I had to find another path. And I think I came in like many people do. I just started looking for businesses to buy. I was never going to start a business from scratch. I didn't have an idea germinating that was keeping me up at night. I just wanted to find a business to buy, an acquisition entrepreneur. And that's how I came into franchising. I started looking for businesses to buy, and I found an 11-unit group in the Sylvan Learning System, their tutoring. And they were in some distress and needed a new owner. So one thing led to another, and I became a multi-unit franchisee.
So you were a franchisee first.
Yes.
And you came in as an owner of an 11-unit operation as your entree to franchising?
The entree. Yep.
Well, that's not something you hear every day either, is it?
No, I don't do anything small. In retrospect, it was kind of nuts. And in retrospect, I would say, what were they doing gambling on somebody that was an unproven business owner? A business experience, yes, but business owner, no. And they're very different. But it was a great brand to be part of. I loved the time. And I ended up growing the business, fixing the things that needed to be fixed and selling it off in pieces because it was a very odd collection of locations. It wasn't a cohesive group at all. And so I gradually sold them off to different owners. And then I decided that, I had invested a lot of my time when I was a franchisee learning about franchising. I went to all the conventions. I got my CFE. Everything wasn't nailed down. I read about franchising. I remember sitting in a training class once on international franchising, which I had no intention of doing, but just wanted to learn about it. And I sat next to Edith Wiseman from Fran-Beta. And she's like, I've never met a franchisee in one of these classes. So I don't know. I think more franchisees would probably benefit from the CFE program, or at least taking a couple classes. But at any rate, I decided to stay in it. And first I started doing franchise development, and then I started doing more traditional management consulting. And that's what led me to private equity, because many of the firms I was working with were working on a growth plan specifically because they were hoping to attract growth capital.
And so what year would that have been?
Let's see. I sold my business in 2018. So since then, I've been doing the consulting.
And tell us a little bit about the consulting business, Emergent Growth Advisors, and who you target and what you do for them.
I work mostly with emerging brands. Helping them to build right in the first place is a huge shortcut. There are so many mistakes that can be made in the early days that come back to bite you, whether or not you want to take on private equity. But certainly if you do, there's a clear checklist of things they don't want to see. And if any of those are on the list, you're sort of diminishing your marketability and your value. So I work with brands there. I also work with folks who are a little farther along and are ready to try to attract capital. There are still things they can do ahead of time. Whether or not they go through a formal banked process or not, there's still benefits to thinking about it early and getting your ducks in a row, getting to know the landscape a little bit, and also really soaking on your objectives. So because you can waste a lot of time in a sale process if you're not clear on what you want and who would be a good partner for you. So I work with those folks. I also work with private equity firms, independent sponsors, family offices, often on due diligence projects. They might have something in mind, an acquisition in mind, and they need help vetting often the franchise development sales process and also just, is this a good concept? What do we think the upside is here? Just to get another pair of eyes on it.
So let's talk for a minute about what an emerging franchisor should be thinking about. I tend to think that too many times emerging franchisors are thinking that they're ready for some type of a liquidity event a lot sooner than they should be.
Mm-hmm.
And they go hoping for things that are probably not ready yet and they're not ready for. So I think that's probably who your client base is, correct?
Correct. Yeah. I talk a lot about that in the book as well. I think it's a very hard message to receive. You've built up this franchise system and you're at, whatever stage you're at. And then you dip your toe in the water and start talking to potential buyers. And the conversations start off great. And then they cool just as fast. And it can leave you with whiplash, right? So you're like, well, where'd the love go? I don't understand. You were so hot to talk to me last week and now suddenly you're not interested. What happened? What happened is they're professional investors and their entire job is to always look at everything. Even if it's a brand they're skeptical of, they'll still take a look at it because they learn from looking at all these things and talking to people. And they get paid for that. You don't get paid for your time to help educate them on, or their fishing expedition. So you've really got to understand what they're looking for and come prepared to talk about those things, because otherwise, you're not setting yourself up for success. And you're right. I think a lot of folks start talking to them early, again, because they start getting these phone calls. But some of the folks calling aren't even from dedicated funds. They're independent sponsors or, they don't have money ready yet. They're just looking for acquisition targets. So you've got to ask them if they're investing out of a dedicated fund just to set your own expectations on timing. And if you think about it, since private equity came into franchising, about 700 brands have received some sort of private equity help, either at the brand level or the franchisee level or both. If you believe Edith Wiseman at Frandata, there are about 4,000 active brands in franchising. So that's less than 20%, meaning there's a lot of brands that for some reason have not taken or attracted private equity. And for sure, there are brands that are very attractive and large scale that just choose not to take a PE partner. So an example would be Sport Clips, huge brand. They've passed that one down in the family, have said many times they don't plan on partnering with PE. Jersey Mike's, a couple months ago, they seemed to be flirting with the idea, at least in the press, but so far nothing's happened. That's a big brand and so far a holdout. But most of the brands in that long tail of unaffiliated brands are not going to attract private equity. They're too small, they're unproven, they're stalled out. There's something about them that PE buyers aren't interested in. So it's not like you can just raise your hand and private equity will fall into your lap and you'll march merrily forward. It takes planning to get it right.
What do you say to an emerging czar or any franchisor that's shopping private equity about what to look for as they're being scrutinized and x-rayed by the PE firm? What's the difference between PE firms?
So when a franchisor is thinking about potential fit, so the first step is you've got to really think about what you want, not what they want, what you want, because that will eliminate many of the options right away. And I think many founders don't really think about that deeply before they start having the conversation. And it's not just about, whether or not you're selling majority control. It's also, where do you want this brand to go? What are you trying to accomplish with the capital, with the help? That will start to suggest what type of sponsor would be best to work with. So for example, let's say you're a med spa and you've got proprietary products that you've developed and you would like to build into a consumer brand where those products could be sold at retail, even outside of your franchise. Well, that suggests a partner would ideally come with experience helping people do just that and actually have a consumer packaged goods background. If you've gotten a lot of interest from overseas and you're trying to identify whether you want to get some of your restaurants open in a different part of the world, okay, maybe you want a sponsor that's got some international development experience. So there's things like that to think about. There's also, are you exiting or are you staying in it? Most PE firms, they want to back a good management team. They're not operators themselves. So you'll probably be less attractive if you want to exit. If you want to exit, you've got to anticipate that and get a lieutenant in place to run the business for you. And then that's part of your story is, I may be retiring, but I've got this great person coming up who's going to run the business. So you've got that lined up ahead. If you're going to stay in the business, now you've got a boss. So I don't care how friendly the conversations are during the courtship process, but everybody's on their best behavior when you're dating. It's only when you live with somebody that you understand if their habits are going to drive you bananas. So this is the kind of stuff you've got to think about. What kind of help do I want? What kind of partnership am I looking for? Because then you can start talking to other founders who have already taken capital and ask them, just like you would if you were a franchisee and want to find out about the franchisor, you're going to need to do some reference checks and ask some really candid questions. It takes a while for the trust to build for founders to be able to share with you everything that they want to share. So there's that piece. And then think about where your brand is in its life cycle. In the book, I talk about what I call the private equity profit ladder, which is essentially this habit that happens in private equity where once a brand is owned by that first private equity company, and this is true whether it's in franchising or not, once that first transaction's done, if it's going to retrade, it tends to retrade to another private equity firm because the thing grows and then it sort of moves away from the emerging brand specialist. Then it takes on a larger fund that's in growth and then another fund that invests in growth. And so as it gets bigger and bigger, it sort of moves up the stack to different kinds of firms. So if you're a 50 unit franchise, you're probably not talking to Blackstone, right? You need to target and think about capital partners that have experience helping to lift exactly a franchise that looks like yours. So that'll help you sort through. And then finally on the financial piece, if you're counting on rolling equity forward and having a second exit that's meaningful, you better check the track record of second exit at whatever short list of companies you're considering partnering with, because that will be a consideration for you. If you're not counting on that, if that's not a factor, you're mostly selling and you're not rolling any equity forward, then you might care less about that. But especially in that first transaction, most founders I work with, they're emotionally tied to the business. They want their baby to do well, and even if they're exiting fully, they still want to put it in good hands. So they will care about those things. Later on, as it's traded a couple of times and the founders fully exited, the new owners of the business are making those decisions. So it becomes less about cultural fit and things like that and more about who's going to pay the best price for the business.
I think we should take a pause here for a quick time out. When we come back, I want to talk some about the cultural aspects of these types of transactions. We'll wrap up talking about your book and making certain we leave plenty of time to discuss that as well. You're hearing today from Alicia Miller, founder and managing director of Emergent Growth Advisors and the author of Big Money in Franchising, Scaling Your Enterprise in the Era of Private Equity. I'm Stan Friedman. This is Franchise Today. Don't go anywhere. We're coming right back.
Franchise Today will be right back. But first, a word from our sponsors.
Franchise Today is brought to you by FRM Solutions, offering the only CRM tool built exclusively for franchising that lets you have it your way. Whether you're a single brand needing professional tools across departments or a portfolio of brands needing franchise-specific CRM across the enterprise. Either way, FRM satisfies the needs of many with the power of one. That's right, one single instance of FRM is all it takes across departments or across brands. So if you've had it with inflexible, one-size-fits-all CRM, end your frustration today. FRM offers robust dashboarding, tailored reporting, and with open APIs, FRM pushes, pulls, and integrates with other databases, providing you with a single source of truth. Don't just take my word for it. Visit them at frmsolutions.com and order up a demo today. And we are back with Alicia Miller talking about private equity and franchising. Alicia, I have a question for you about culture, because I worry in this era of roll-ups and umbrellas and companies swallowing companies up at the speed of light. What are your thoughts on what happens culturally to a brand when a founder is taking a liquidity event? And, well, I guess he stays in for a couple of years, but the culture has to be changing on two fronts, I think. One being the founder's role now, as you suggested, he's no longer the leader of the company, and that's got to work on him or her and put some head games into motion. And then what about the franchisees who bought into the founder's vision and things change now under a corporate structure and private equity? Do you worry about that, or is that something that just comes with the game?
I don't worry about it. It's part of the game, but it's certainly something that founders need to think about, and franchisees, when you're evaluating a potential system that you want to get into or stay in if there's an ownership change. From the founder's perspective, I think it's pretty predictable that an entrepreneur now has a boss that isn't always comfortable, even if the boss is awesome. So it's got to be worth it to you. The help and capital and acceleration, what they bring to the table, and their working style with you is going to be really important. So you've got to vet, of course, with other founders they've worked with. Are they good to work with? Everyone's fine when the business is growing. Find out what happens when the business has hit problems. What behaviors come out? Do they micromanage? Look, it can be really frustrating when you've decided this is the batter you're going to use in your cake and you've tried 50 batters to get to the cake that you think is right for your bakery. And then private equity comes in and says, well, have you tried this supplier? Yeah, we've looked at that supplier. We already covered that. We don't need to go back and re-examine that decision. But that's what PE does. They like to optimize. So you've got to be willing to work with them and work through those kind of database questions. They want to prove out every assumption and flip over every rock to try to find opportunities. On the franchisee side, there are very clear pros and cons of working, having private equity come into the system. In theory, PE's growth agenda should be pretty well tied to franchisee interests because in order to grow, you need franchisees to be satisfied and wanting to invest in more territories and validating well. So they'll invest in accelerators like marketing. They'll add staff. They'll improve the tech stack, things like that. So the system itself should be stronger and better, and AUVs, average unit volumes, should improve through this more rigorous approach to running the business. And so you can see that there's definite positives, that growth mindset and incentives tied to growth and more management focus on unit profitability is all good. But as the brands trade amongst PE firms up this ladder, the change itself can be hard. Sometimes brands have to change to keep up with the times, but change is hard. And so a franchisee who comes in when it's a founder-led culture, they get to that first PE transaction, and that's like the first growing up stage. Now we're going to try and optimize this thing. So the first thing that happens is they shut down exception requests. You used to be able to call the founder. Now you've got to submit a help desk ticket. Franchisees don't like that. They might even change what kind of franchisees they want in the system. And then the second PE money comes in and things really start to pick up the pace. And by that point, the founder exits, usually. That's the biggest cultural thermocline, is that second PE owner, because culture is less of a consideration for that first PE seller. They're just looking for a great exit. That's their mandate for their investors. So there can be big changes in culture at each of these transition points. Now, if the sponsors are smart, they will try to preserve what's powerful and unique about that culture and that relationship with franchisees. But it's an easy thing to mess up if you're not paying attention to it. So that management team has got to be a really good steward of that culture. And you've got to ask great questions, your fellow franchisees, about cultural change and what's good and what's bad. Some things in the culture need to change in order for it to become a scale brand, but other things are not as pleasant. And the biggest question to ask is, how do they manage change? Are franchisees consulted? Is our opinion worth anything? Do they roll out changes without testing things, without asking us? You want to know that stuff. And that'll tell you a lot about where that brand is really going. Because if there's a disconnect building between franchisees and management, no matter who the sponsor is or whether it's publicly traded, doesn't matter. It's probably heading for a stall out once that triangle of trust between the sponsor, management team, and franchisees starts to break down.
Long before COVID, the Dwyer Group, I guess, was the gold standard in the creation of Neighborly for verticals to kind of group together. And I guess private equity, in that case, I think Riverside bought that company twice, didn't they?
3 times.
3 times.
Mm-hmm.
But we're seeing an accelerated pace of that happening since COVID. And in the last year or two, I think more and more companies are just rolling up into verticals and buying up everything they can in that market segment and just throwing things together in a hurry that don't look to me a lot like what you're describing should be the case. What's your view on that?
So consolidating fragmented sectors is what PE does well in or out of franchising. And there's a lot of sectors like home services that you can consolidate and share a lot of the back office, or at the very least share the leads and some of the marketing and do better. I think it's also a symptom of the fact that PE has sort of picked over the sector pretty effectively. There are fewer scale brands that are unaffiliated that are willing to consider a PE transaction. So that forces prices up for those good quality brands that are willing to play. It takes existing brands and forces their prices up. So when they're ready to retrade, they retrade at a nice multiple. And it also forces some of the activity down market into smaller brands than maybe they would have liked. And one of the ways they do that effectively is through platforms, because then you can acquire a subscale brand and stick it in a platform. And if you do the right things and nurture it, then you can still grow that and you get a little bit of multiple arbitrage happening because the whole is worth more than the sum of the parts you've acquired. But it still takes a kind of a specialist to be able to take those little brands and build them into something really substantial. It's just hard. Neighborly's got some quite large brands in it. If they go and buy a smaller brand, it'll see a lift for sure. But it's even for somebody like Neighborly, that's hard to do. It can't be too small.
Before we get to talking about the book, Alicia, what have I not asked you that perhaps I should have before we roll into the book?
I would say, what's all this PE activity mean for franchising? How much is that on people's radar? I think it's still really not on people's radar, unfortunately. It's on the radar of people who want to sell their business. And so they've realized that PE is a good potential buyer. But I still think there's an awful lot of franchisees coming in that don't have any understanding of this dynamic and how it's changed competition. And then that's unfortunate. I hope they find the book. I hope they find other resources to help educate them. But if they're joining an emerging brand in a crowded field that's quite small, that brand is really going to struggle to get to scale. Franchisees need to understand that. And emerging brands will help themselves a lot if they consider the landscape and come in as well capitalized as they can be so that they hopefully can delay taking a partner and can continue to grow in a terrific way.
Well said. Let's talk a moment about the book and tell the audience what they can expect when they pick up big money in franchising and learn more about scaling their enterprise in the era of private equity.
So I tried to make it very practical. It's a complicated topic. So it is a chewy read. It's not a breezy beach read necessarily, although I get a lot of pictures from people at the beach with my books. Like, here's where I'm reading your book today kind of pictures, which is nice. I take the landscape and break it into the pieces as I described, and then walk people through checklists of here's what you need to be thinking about based on your own unique situation. And there's a lot of case studies as well, which I think will really help people unpack what they're seeing around them. Because you see these headlines of people getting acquired or people taking money, and it's hard to know from the outside what that really means. I think this will give them the tools to think through it a little better and then to make better decisions. I hope it does.
Let's spend the minute that we have left to talk a little bit about Emergent Growth Advisors and who it is that should be checking that out for what their next stages of franchising looks like.
I work with brands at all stages that are wanting to grow smart and have a good exit transaction when they're getting ready to do that. But some of the brands I work with for years before they actually are going to plan to do anything, which is great because they've got a long runway. They can make improvements, they can pull the right levers and be very well prepared, not do things in a rush. So any emerging brand that has aspirations someday of building themselves into a substantial business is somebody that I'd love to talk to and try to help.
Well, then why don't you tell them how to go about finding you?
You can find me at emergentgrowthadvisors.com, or if it's easier to remember, bigmoneyinfranchising.com leads you to the same place. You can submit a request there or find me on LinkedIn. Is the other good place to find me.
And let me give a plug for an upcoming event that I know you're going to be speaking at the Fay Gray Summit. Tell us about what's coming up there and who should attend.
That's a great summit for networking purposes and also to hear a lot of current information on franchising from those who are going through transactions, who are growing their business and sort of what they're seeing in the market right now. We've got a wide variety of speakers on a bunch of different topics, but the overarching theme is responsible franchising, which is very topical right now. So encourage if you got the time. It's the end of July up in Minneapolis, and it's shaping up to be a really great event.
You know, I had the domain sensiblefranchising.com way before responsible franchising became cool. I just thought I'd drop that. I'm very tired of the word responsible in front of franchising. I like sensible, and responsible should just be point of entry in my mind. But here we are in an era that we've got to put a spotlight on that word because too many people have misbehaved, I suppose.
Well, I don't know. We could have probably a whole separate episode on that topic, right?
I'm quite sure that you're 100% correct. So instead of that, I'm going to say thank you for joining today. Thank you for being here. Look forward to seeing you in Minneapolis at the Fay Gray Summit, and we can spend some more time there talking more about this and other things of interest to all of us. This has been a lot of fun and very enlightening and very insightful. And I thank you, Alicia Miller, for joining us and spending some time here dropping nuggets on the audience of emerging franchisors at Franchise Today.
Thanks very much. Appreciate it.
Well, that's a wrap for this week. Next week, we take a break as I'll be traveling to the Fay Gray Franchise Summit, but I'll be back on August 7th with another very smart woman in the franchise world when I'll be talking with Aisha Boscaro, founder and CEO of the American Franchise Academy. You don't want to miss this one, I guarantee it. Until then, I'm Stan Friedman, wishing you the best, the very best of all things franchising, and Franchise Today is out.
Franchise Today is a production of FRM Solutions, providing best-in-class CRM tools to empower relationships with prospective and existing franchisees. Find them online at frmsolutions.com. Join Stan every Wednesday at noon Eastern for another episode of Franchise Today.
When you're part of a military family, you understand sacrifice and support. So at American Public University, we honor your dedication by extending our military tuition savings to your extended family. Parents, spouses, legal partners, siblings, and dependents all qualify for APU's preferred military rate of just $250 per credit hour for undergraduate and master's level programs. American Public University. Value for the whole family. Learn more at apu.apus.edu/military.